Welcome to the Explainer. Okay, so you've poured your life into building a successful business, right? But have you really thought about that last, crucial step? Today, we're going to break down the playbook for planning your business exit and making sure you get it right. So here's what we've got on tap. First, we're going to talk about why this is such a high-stakes game. Then, we'll get into what it really means to be exit-ready. After that, we'll walk through all your options, both inside and outside the company, and we'll wrap it all up with the one thing that can make or break the deal: timing. All right, let's dive right in. First up, understanding the stakes. And believe me, for business owners, they could not be higher. Okay, get this. For most owners, a staggering 80% of their personal wealth isn't sitting in stocks or real estate. Nope, it's locked up, right inside the business they built from scratch. We're not just talking about a company here. For so many people, this is their entire life savings. And here's the kicker. Even with all that on the line, there's a really sobering reality we have to face. 50% of all business exits aren't planned. They're forced. We're talking about things like sudden health issues, burnout, partnership blowups, you name it. For half of all owners, the choice to leave isn't even theirs to make. And you want to know what happens when you're not prepared? The result is just staggering. Without a solid plan, a full 75% of owners deeply regret selling their business just 1 year later. I mean, think about that. That is a huge number, and it points to some serious, widespread dissatisfaction. So the big question is, how do you make sure you're not one of those stats? How do you end up in that successful minority? Well, the answer is pretty simple, but it's not easy. It all comes down to one word: preparation. That's what unlocks your wealth, secures your future, and lets you walk away with zero regrets. Okay, so that brings us right to the foundation of any successful exit, which is this whole idea of readiness. Now, it's a term that gets tossed around all the time, but what does it actually mean to be exit ready? And this is maybe the most important distinction we're going to make today. Exit readiness isn't about waking up one morning and feeling like you're ready to sell. Not at all. It means your business is factually prepared for a transition at any time, whether you decide to pull the trigger or not. You know, a great way to think about it is like a two-sided coin. On one side, you've got your personal readiness. I mean, are you truly, financially and emotionally ready for what comes next? And on the other side, you've got the business's readiness. Can it not just survive, but actually thrive without you at the helm every single day? For a truly successful exit, both of those have to be a big, fat yes. All right, so once you've got that foundation of readiness sorted out, then you can start looking at your options. And let's start with the first big category: internal transfers. These are the paths that keep the business, a little closer to home. So first up, we have the classic, the one you see in the movies, the intergenerational transfer. For a lot of founders, this is the ultimate dream, right? Passing the business you built down to your kids or other family members. But with this option, you're really looking at a fundamental trade-off. The pros? They're mostly emotional. You get to preserve your legacy, you keep more control. The cons, though? They tend to be very practical and very financial. Family dynamics can get, messy, and you will almost certainly get a lower sale price than you would on the open market. That's just a fact. Okay, next on the list is something called a management buyout, or MBO for short. And it's exactly what it sounds like. You sell the business to the people who probably know it best, your existing management team. So, the biggest pro here is continuity. I mean, your team is already in place, they're motivated, the company culture stays intact. The challenge, though, and it's a big one, is almost always money. Your managers might be fantastic at running the business, but they rarely have the kind of capital needed for a full-price buyout. And that often means you have to finance a big chunk of the deal yourself. And our third internal option is an employee stock ownership plan. You'll hear it called an ESOP. Now, this is a really powerful, but also pretty complex tool that basically transfers ownership to all of your employees through a special kind of trust. So, what's the appeal? Well, ESOPs can offer some incredible tax advantages for you, the seller, and they can totally supercharge employee morale because now everybody feels like an owner. But you gotta be prepared. ESOPs are complicated, they're expensive to set up, and it's usually a much more gradual, slower exit process compared to a straight-up sale. Okay, so that covers the internal routes. Now let's shift gears and look outside the company. What happens when you decide to take the business to the open market? What are your external options? All right, this is the one most people think of when they hear the phrase selling a business.
It's a sale to an outside third party. And that could be anyone from a direct competitor to a bigger company in your industry or even a private equity group.
And this path, more than any other, presents a really stark trade-off between price and process. On one hand, a third-party sale will almost always, hands down, get you the highest price and the most cash up front. But, and it's a big but, it comes at a cost. It's a long, it's a complex, and frankly, it's an invasive process that can take a real emotional toll.
Okay, another external option, this one's a bit more sophisticated, is called recapitalization. So instead of selling the whole shebang, 100% of the company, you sell a portion of it to an investor or a partner, often a private equity firm.
Now, this can be a fantastic option if you want to diversify your personal wealth. You'll hear it called taking some chips off the table. But you still want to stay involved and get a second bite at the apple with future growth. The downside? Well, you're not the sole decision maker anymore. You've got a partner now, someone you have to answer to, and that can be a massive culture shift. Okay, so now you know your options, both inside the family and out on the open market. But the success of any of these paths, and I mean any of them, hinges on one final, absolutely critical variable: getting the timing right. You see, a truly successful exit, one where you really maximize everything, only happens at this rare intersection of three different timelines. First, there's your personal timing. Are you ready, mentally and financially, for what's next? Second, the business's timing. Is it at a peak in its growth cycle, or is it on the decline? And third, you've got market timing. Are buyers out there paying top dollar? Is money cheap to borrow? For the perfect exit, all three of those have to line up. And that really brings us to the final and maybe the most important point of all. The ultimate goal of all this planning, it isn't just about selling your business for the most money possible. It's about creating the financial freedom and the peace of mind that lets you fully and enthusiastically answer that one big question: what's next for you?